The market is currently closed for the weekend, and looking back at the last full session on Friday afternoon, June 12, 2026 at 4 p.m. Eastern Time, Nuburu Inc., trading under the ticker symbol BURU on the NYSE American, finished the day at exactly $0.15 per share, marking a decline of 5.33% for the trading session on an intense volume of 26.29 million shares. While a casual glance at this price tag might cause everyday retail traders to look the other way, thinking it is just another standard microcap stock struggling under the heavy weight of extreme market pressure, a far more interesting narrative is unfolding beneath the surface that completely subverts standard expectations. The broader market operates under the shared assumption that a sub-dollar penny stock facing immense volatile swings is merely grasping at straws to stay afloat. Yet the real development driving massive volume spikes into Nuburu right now is a highly aggressive international expansion plan centered around defense, cybersecurity, and advanced maritime laser infrastructure that is quietly shifting the company away from its historical industrial roots. By looking past the surface-level price decay, serious market participants are noticing that Nuburu has been executing binding agreements in Europe, specifically through its Italian subsidiary Liocon, including a massive 70% majority stake acquisition of an Italian industrial firm called Tecne that could potentially unlock up to $459 million in cumulative projected revenue visibility between now and 2030, a figure that dwarfs the firm's current microscopic market capitalization of roughly $27 million. This stark contrast between investor expectations and structural reality is exactly why the order flow on retail brokerages has started showing highly irregular patterns. If you monitor high-volume environments where people engage in self-investing or use specialized investing sites to track microcap anomalies, you will see that the general crowd expects a company trading near 15 cents to be completely dead in the water, devoid of institutional interest or concrete commercial catalysts. The reality, however, is that Nuburu is actively repositioning itself into a high-stakes dual-use platform, bridging the gap between specialized commercial manufacturing and national security defense contracts. For instance, just within the past few weeks, the company filed a formal golden power notification with the Italian government to initiate the regulatory review of that Tecne acquisition, signed agreements to design specialized blue laser power beam setups for underwater submarine power platforms with SunCubes, and secured new cybersecurity orders through its software arm Orbit. These are not the typical moves of a bankrupt microcap, yet the market is pricing the stock as if total liquidation is right around the corner, creating an incredibly tense psychological dynamic for anyone holding the asset. To truly understand how this tension impacts your portfolio, we have to analyze the massive waves of volume pounding this stock daily. During typical low-tier equity cycles, a minor firm might see a few 100,000 shares change hands, but Nuburu has consistently seen daily volume figures tracking in the tens of millions, often exceeding 25 million shares in a single 6-hour session. This indicates an absolute battleground where short sellers, speculative retail accounts using the Robinhood app, and institutional risk takers are actively clashing over the company's ultimate survival. When trading volume reaches these extreme heights relative to the float, it usually means big capital is either positioning for a massive restructuring squeeze or distributed blocks are being dumped to fund ongoing operational deficits. For an individual brokerage account holder, seeing this level of velocity can be incredibly deceptive because while the underlying announcements sound massive, the immediate reality of the stock price remains pinned near its absolute 52-week lows of 14 cents, far away from its 52-week high of $4.24. This heavy price suppression is largely driven by macroeconomic factors and severe internal financing constraints that continue to test the patience of the market. High interest rates throughout the broader economy have made microcap debt financing brutally expensive, forcing smaller technology entities to rely on dilutive equity financing structures or complex share purchase agreements just to keep their research and development pipelines active. When retail investors open up their online investing accounts or use a Fidelity trading platform to scan for undervalued small caps, they often forget that a company can possess highly valuable proprietary technology, but still get completely crushed by short-term cash flow shortages. Nuburu's financial reports from earlier this year highlighted a quarterly revenue of just over $400,000 against multi-million-dollar selling, general, and administrative expenses, which naturally leads to substantial operating losses and a net profit margin deep in the negative territory. This financial imbalance is the core anchor holding the equity down, forcing a massive gap between the grand corporate vision of global defense infrastructure and the cold, hard cash reality found on the balance sheet. Let's pause here for a moment because I want to hear directly from you on this specific setup. Comment below how many shares of Nuburu you currently hold in your portfolio, or if you're choosing to stay completely on the sidelines while this penny stock volatility plays out.
Looking closer at sector momentum, the defense and directed energy markets have seen massive capital inflows recently, driven by escalating global tensions and the urgent need for counter-drone technologies. This macro environment should theoretically serve as a powerful tailwind for Nuburu's newly established laser arm initiative, which specifically targets the fast-growing counter-unmanned aircraft systems sector across US and allied European regions. The market expectation was that Nuburu would remain a niche player selling industrial lasers for basic copper welding, but the reality is that their high-brightness blue laser IP is being adapted for high-power military applications, where standard infrared lasers fail to deliver the necessary absorption efficiency. This technological edge is precisely why strategic partnerships are forming, yet the disconnect remains absolute because institutional asset managers utilizing a fidelity brokerage or interactive brokers platform cannot easily deploy millions of dollars into a stock trading under $1 without triggering severe regulatory compliance restrictions, leaving the equity vulnerable to extreme retail-driven swings. To understand how the business model actually functions under the hood, we have to look back at the core technology that founded the firm in 2015. Headquartered in Denver, Colorado, Nuburu built its original reputation on developing and manufacturing high-power, high-brightness blue lasers, notably their AO150 and Nuburu BL systems. The fundamental physics behind their business relies on the fact that metals like copper, gold, and aluminum absorb blue light at a rate that is up to 20 times higher than standard industrial infrared wavelengths. In practical terms, this allows manufacturers in the automotive, aerospace, and consumer electronics industries to weld critical components significantly faster and with vastly superior quality, eliminating common structural defects. This established a strong foundation in the additive manufacturing and battery assembly spaces, which older reports continually highlighted as a major growth engine as global electric vehicle production ramped up over the past several years. However, the transition from being a specialized hardware supplier to a multinational defense contractor is where the narrative gets highly complicated and risky. The recent acquisition strategy of taking a 70% stake in Techne represents a total transformation of their corporate scale, shifting them from a quiet domestic manufacturer into an entity with heavy international regulatory oversight. Because Techne deals with critical industrial and defense components in Europe, the transaction is subject to strict governmental approvals, such as Italy's Golden Power Law, which protects strategic national assets from foreign control. This introduces a massive layer of political risk that everyday investors using standard online investing tools might completely overlook. If the Italian government views the acquisition unfavorably or imposes heavy structural restrictions, the entire 5-year business plan projecting hundreds of millions in cumulative revenue could fall apart instantly, leaving Nuburu exposed to the severe costs already sunk into the legal and advisory process. At the same time, the company is attempting to build a comprehensive software command layer by acquiring 100% of Orbit, a cybersecurity firm in which they currently hold a minority stake. This move is designed to pair their physical blue laser defense weapons with advanced digital infrastructure, offering an integrated package to Tier 1 national telecommunications and critical infrastructure operators. While this diversification sounds incredibly robust on paper, it requires vast amounts of capital to integrate separate international business units, manage foreign compliance, and sustain multi-year development cycles before these long-term defense orders translate into actual cash flow hitting the bottom line. This brings us right back to the central problem of expectation versus reality. The company is communicating a massive corporate evolution, but the current daily stock price reflects an immediate market that is highly skeptical of their ability to fund this expansion without severely diluting existing shareholders. When you look at alternative methods of managing risk in this volatile market environment, many long-term investors naturally lean towards automated or institutional frameworks rather than direct microcap speculation. For instance, platforms offering Schwab Intelligent Portfolios or an automated intelligent portfolio system generally steer clear of hyper-volatile penny stocks altogether, focusing instead on broad market asset allocation and diversified funds. Similarly, if you explore options through Fidelity Wealth Management, Fidelity Mutual Funds, or Stable Fidelity ETFs, the overarching strategy is to capture steady macroeconomic growth while insulating capital from the catastrophic downside risks associated with individual microcap failures. Even self-directed traders using advanced features on the interactive brokers trading platform or a multi-asset individual brokerage account often allocate only a tiny fraction of their capital to high-risk plays like Nuburu, using the rest to backstop their portfolios with highly liquid blue-chip large caps. As we look towards the future outlook for Nuburu, several distinct scenarios could play out over the coming quarters, each presenting its own set of catalysts and severe risks. The most immediate upside catalyst would be a clean, unrestricted approval of the Golden Power notification by the Italian government, allowing the Techne acquisition to close successfully. If that occurs, Nuburu can instantly begin consolidating substantial European revenue figures into its financial statements, completely transforming its top-line appearance and potentially forcing a massive reassessment of the stock's valuation among small-cap analysts. Such an event would likely trigger a violent short squeeze, as short positions are forced to cover rapidly in a low-float environment, causing the type of explosive upward price swings often tracked on volatile online investing platforms like SoFi Invest or the Robinhood app. Conversely, the downside scenario is equally stark and must be weighed carefully by anyone participating in self-investing. If the European regulatory hurdles prove too high, or if the projected funding required to turn Techne around causes massive capital shortfalls, Nuburu could be forced to execute massive reverse stock splits or issue highly toxic convertible debt instruments to survive. We have seen this pattern play out repeatedly across the microcap landscape, where retail traders buying the absolute bottom get completely washed out by consecutive rounds of dilution. The reality of a 15-cent stock is that the margin for error is non-existent. The company is operating on a financial tightrope, and any operational delay, missed contract milestone, or unexpected legal hurdle can result in immediate downside pressure, pushing the equity towards new historical lows. Ultimately, evaluating a stock like Nuburu requires an absolute stripping away of emotional bias and corporate hype. The expectation created by the company's recent press releases is that they are on the verge of capturing a multi-billion-dollar maritime and defense market through elite blue laser technology. The reality written across the tape is a stock price sitting at 15 cents, fighting massive daily volume battles and locked in a race against its own burn rate. Serious market participants who analyze these setups through an individual brokerage account or professional interactive brokers platform know that technology alone does not guarantee equity growth. Execution, regulatory clearance, and capital preservation are what ultimately dictate whether a microcap transitions into a legitimate mid-tier enterprise or fades away entirely. To summarize the central insights of this deep analysis, Nuburu stands at a critical historical crossroads where its survival hinges entirely on international corporate engineering. The market has priced the asset based on its historical financial losses and structural penny stock status, creating an expectation of imminent stagnation or continued decline. However, the reality of their aggressive tactical pivot into European defense systems, underwater laser power platforms, and critical infrastructure cybersecurity presents a highly complex, high-reward counter-narrative that the current price tags have completely disconnected from. Whether this structural disconnect represents a generational value dislocation or a dangerous value trap depends entirely on the upcoming regulatory decisions in Europe and the company's near-term funding choices. As this intense battle between market narrative and operational execution continues to unfold on trading desks across the globe, maintaining a cold, analytical perspective on the tape is your only real protection against the chaotic swings of high-volume microcap speculation.